What could a limited partner expect in, a range of returns for an asset like this, without really speaking to 7 Square, but something like this? What could I expect from a range in terms of preferred rate of return annually and perhaps a exit multiple?
Sure. So we're generally picking deals that underwrite to 16% gross IRR, which would translate into about a 13.5% net IRR for LP investors, passive investors. That 13.5% is going to be a mix of cash flow and appreciation when we sell. Typically, cash flow in these deals might average 7, 8, 9% over a 5-year hold. Now, within that, you're probably not going to get 7, 8, 9% in year one. Year one is when your yields on the project are thinnest and you're doing work to improve the asset and ramp the income. And so year one might be, in this market, with valuations where they're at, it might be 4 or 5% in year one. And hopefully by year 5, you're at, 10%. It could potentially be better if you're buying a cheaper price point value add deal. You might be able to do better. If rent growth is faster than expected, you might be able to do better. On the other hand, if we hit a recession, it might be worse. And so it's always a long game with multifamily. But generally 7, 8, 9% average cash flow over the 5-year hold, and 13.5% net when we exit. Now, the market's been so hot over the last few years that we've crushed those return numbers, but you can't get unlimited cap rate compression forever. And so we don't forecast 20s and 30 net IRRs like we've achieved on some of our projects. And so we like to be realistic and put out numbers that we think are meetable and hopefully beatable.
Let me make one quick comment. People get scared of the red, but sometimes the red is part of the plan, right? And again, losses and tax write-offs and tax planning. When you're at that point where you need to have a tax team to offset your gains, losses can be a great thing. I have investors that I work with that we're constantly reallocating their investments to capture losses year over year versus the gains, right? So a savvy investor does not run away from losses. They strategically place them in certain years to offset gains, by the way.
So what Tom's referring to is in real estate, you get depreciation to help further shield your income of the asset, which is a phantom expense. And in year one of any project, we perform a cost segregation analysis that allows us to take, a mega big depreciation write-off. So you get to carry those losses back. You get to carry them forward. You offset any other passive income. It's not going to shield your W-2 paycheck income if you're not a full-time real estate investor. But if you have other passive gains and income, it does shield that. And you're essentially, getting your cash flow for free, tax-free along the way. Those are not, hopefully not real losses. Hopefully they're just depreciation.
That's right.
And then down the road, when you sell, you're selling at a capital gains rate and not, a very high income tax rate.
And there will be a step down based on the depreciation that you do take when you ultimately dispose of that asset.
That's right. So your gain is larger because you've written off depreciation. Hopefully that depreciation is shielding your other income. If it doesn't, then you get to recapture that depreciation and you don't pay for that loss.
Yeah. And tax is one topic that makes people sleepy, including myself, but it's really important. And I had Brandon Hall on a conference recently, and I asked them what is the most strategic tax play out there, and these sort of investments that Craig's managing is exactly that. It's more so than oil and gas in terms of the benefit to taxes. So if you're looking for a tax break, tax write-offs on top of returns, it doesn't get much better than this.